Joins us now to tell us about what makes sense. So we're looking backwards at 2008. Tell us what was good. Was there anything?
Well, there wasn't much, Brittany. I mean, if investors had money parked in the bank, of course, maybe they were earning, at some point, give or take 3%, 2 or 3%. If you had invested money in certain bonds or bond mutual funds that were pretty much away from anything related to mortgages, there could have been gains in the 5–6% range, depending on when you might have entered into the gold market. If you're in the whole year, you might have made a little money, but if you got it at the wrong time, you lost money, maybe even 20 or 30%. Folks that got into treasury bonds, particularly the longer bonds, 10, 20 years and so forth, had sizable gains in the 15–20% range last year.
So that's the good, but there was probably a little bit more bad,
it was a tsunami that just swept over everyone. If you look everywhere else, like you said, there just really wasn't many places to hide. If you look at the broader indexes of gold metals, add in silver and platinum, aluminum, everything else, you lost money last year. If you looked at commodities, whether it's oil, gas, corn, wheat, you lost money last year to the tune of, 30% or more. And then if you looked at U.S. stocks, again, stocks of large companies, stocks of small companies, you're down 35 to 40%. If you go overseas and looked at foreign markets, developed economies, emerging economies, you were down even more. It could be anywhere from 40 to 50%. In specific sectors, like the financial sector, many of those stocks were off 70, 80, 90%.
And so what about diversification? We've talked a lot about that. Did it work? Did it not?
Well, it was one of those years where yes and no, I think, is the answer out of both sides of my mouth. On the one hand, if you invested in a broad, diverse basket, your losses may have only been, emphasis on only, -20, -30, -40. That's better than -50, -60, -70. So diversification did help lessen losses, but it did not make us immune. So it was just a rare year where a lot of assets that often de-link. Sometimes stocks may have a bad year, but bonds have made money, or real estate will make money when stocks are falling, or vice versa. A lot of these things that often de-link in performance didn't. So it was a tough year for diversification.
And so what's now? What's next?
Well, I think we have to step back and say, okay, this is 1 year. Let's close the book on it and put it behind us. I think diversification still makes sense going forward. We need to stop right now and assess, okay, where am I now? Taking the damage into account. Going forward, what type of investment strategy do I need to put into place to get to where I need to be? I think stocks still need to be in that portfolio, because at this point we have to decide what's the greater risk, that this could fall further, or the risk that I might miss some of this repair and recovery that is coming. We just don't know when.
All right. Thanks very much, Paul. As always, we appreciate it. Good to see you.
My pleasure.
And now here's Chris Budden with a look at your sports.